I'm Brian Arcese, Portfolio Manager on the Foord Global Equity Fund and Foord International Fund. We've recently celebrated the 40th anniversary of the founding of our firm, Foord Asset Management. Since our inception, we've focused steadfastly on delivering real, risk-adjusted returns to our investors, ever mindful that the only true measure of a manager's worth is to compound investor assets steadily and in real terms over time. A confluence of factors, not the least of which is globalization, not only resulted in over a decade and a half of benign inflation, but has also created a sizable cohort of investors who has no experience living through or constructing portfolios for a properly inflationary environment. At Foord, we began warning investors of the potential for an acceleration in inflation more than 2 years ago and began positioning our own portfolios accordingly. The never-before-seen fiscal stimulus, a direct government response to the COVID pandemic, saw up to 40% of a nation's annual GDP being placed directly into the pocket of global consumers. The resultant rebound in excess demand, when confronted with initially COVID-caused supply chain disruptions, resulted in rapid and meaningful price increases. The current popular debate revolves around the transitory or structural nature of the current inflation, though as always in our minds, taking a binary view is a fool's errand. We deal in probabilities, forecasting not only a range of outcomes and their respective probabilities, but also the impact of our portfolio of each. Our current base case, with a probability meaningfully higher than 50%, includes a moderation of inflation from current levels. However, inflation remaining meaningfully higher over the medium term than has been experienced at any time than in the past 15 years. There are a number of contributors to these inflationary tailwinds, including the following. Underinvestment in traditional energy resources has and will continue to result in a supply crunch for many years before renewable generation accounts for a sufficient proportion of supply. Global supplies of many industrial metals, including copper and several rare earths required to further the energy transition, are currently not sufficient enough to meet requirements. Agricultural inflation, though currently experienced acutely as a result of Russia's invasion of Ukraine, will remain elevated as countries globally are forced to rethink food security and begin to procure at least a portion of their required food intake at home, regardless of cost. Though we hope for a peaceful resolution of the current conflict in Ukraine, regardless of outcome, the countries that previously weren't convinced of the necessity to onshore a portion of strategic materials, including semiconductors, certainly are now. Even if only a small portion of a country's semiconductor demand is onshored, in the coming years, this will lead to and add to inflationary pressures. Corporate margins remain at record highs, a plain-to-see demonstration of the fact that profits have flowed disproportionately to the owners of capital rather than labor. The reversal of this trend, already evident in many parts of the world, will continue with pressure on wages to remain or increase. Though previously believed to be disinflationary, aging populations are not necessarily proving this prior assumption. Though reallocated, primarily to healthcare, aging populations have not proven to spend less money. Rather, they decrease the number of available workers in a given population, in turn, also potentially pushing up wages. How does one position for the above base case? While equities have proven to be a solid hedge against inflation over the long term, short-term accelerations wreak havoc on investor sentiment, earnings, and valuation. The equities that remain in an investor's portfolio must have pricing power, a high likelihood of maintaining margins, and/or directly owning real assets themselves. Likewise, fixed credits perform poorly during accelerating or uncertain inflation. A fixed coupon payment that has, by definition, no ability to rise in line with inflation is a recipe for negative real returns. We've chosen to take equity positions in companies that directly own real assets. Materials firms that cover the industrial, agricultural, and precious metal complexes now account for nearly 20% of our global portfolios. Positions that have been built over the past 2.5 years and longer. As highlighted, we construct well-balanced portfolios positioned to grow investors' wealth, not only through the current period of high inflation, but also in the event our base case doesn't come to fruition. Perhaps the Fed successfully squashes inflation expectations with a telegraphed series of rapid and sizable rate increases. In this second scenario, one of many, our materials holdings are also likely to perform well, as they're directly exposed to areas that will require increased investment, including for the transition to renewable generation and increased food security. At present, we're comfortable with our positioning as the materials holdings in our portfolio have helped generate 400 basis points of outperformance during the first quarter in our global equity fund, and a total return of 6% in our multi-asset fund, against a peer group that posted a 5% decline during the quarter.